Central bank digital currencies, hated by free-thinking and independent types, coveted by governments and central banks, and we need to ask why. What are the dangers lurking behind digital currencies in general? Let's talk about it. Firstly, what is a CBDC? Well, at a high level, it is a digital version of a country's official currency. Think of it as a digital pound, dollar, or euro issued and backed by the central bank. This makes it fundamentally different from the money in your bank account, which is a liability of a commercial bank. Does it differ from your normal cryptocurrency? Yes. While both are digital, a CBDC is centralized and issued by a country's monetary authority, while cryptocurrencies are typically decentralized, meaning they are not controlled by a single entity. Does it replace normal currency? For now, most central banks around the world envision a CBDC as a complement to physical cash and commercial bank deposits, not a replacement for them. The goal is to provide another safe and convenient payment option in an increasingly digital economy. Well, until by the stroke of a pen as an act of government, it suddenly replaces the normal currency. More on that later. What is the purpose of a CBDC? 1. To modernize the monetary system, whatever that means. 2. To foster innovation and competition, such as new payment services and products to be built upon, fostering innovation in the financial sector. 3. To improve the efficiency of payments. There's a potential to make cross-border payments faster, cheaper, and more efficient. 4. To enhance financial inclusion. For individuals who may not have access to traditional banking services, a CBDC could provide a safe and accessible way to participate in the digital economy. Let's talk about projection. Central bank digital currencies are gaining momentum globally, with many nations exploring their potential to modernize financial systems. However, behind the promise of efficiency and inclusion lies a host of significant disadvantages that have sparked debate and concern among economists, policymakers, and the public alike. These drawbacks range from the erosion of privacy and the potential for financial instability to new avenues for cyber attacks and the risk of unprecedented government control over individuals' financial lives. A primary concern revolves around the erosion of privacy. Unlike physical cash, which allows for anonymous transactions, a CBDC would leave a digital trail of every purchase and transfer. This data, held by the central bank, could be susceptible to misuse, creating a detailed profile of an individual's spending habits, location, and associations. Critics warn that this could lead to a surveillance state, where financial privacy is a relic of the past, potentially paving the way for social credit systems that reward or penalize citizens based on their financial behavior. The potential for financial instability is another major red flag. In times of economic uncertainty, the ability to instantaneously move funds from commercial bank deposits to a risk-free CBDC could trigger massive digital bank runs. This could destabilize the traditional banking sector, which relies on these deposits to fund loans and drive economic growth. The introduction of a CBDC could also lead to a disintermediation of commercial banks, as individuals might prefer to hold their money directly with the central bank, reducing the lending capacity of the private sector. Cybersecurity vulnerabilities present a significant and ever-present threat. A centralized digital currency system would be an attractive target for hackers and hostile nation-states. A successful attack could have catastrophic consequences, from the theft of funds and the compromise of sensitive data to the complete disruption of the financial system. The technological infrastructure required to secure a CBDC would need to be exceptionally robust and constantly evolving to counter new and emerging cyber threats. Furthermore, the implementation of a CBDC could grant governments an unprecedented level of control over citizens' finances. The programmable nature of a digital currency could allow for the implementation of controversial monetary policies. For instance, governments could impose negative interest rates directly on individual holdings to stimulate spending, set expiry dates on funds to encourage consumption, or even restrict the purchase of certain goods and services. This level of control could be used to enforce policy, but also raises serious questions about economic freedom and individual autonomy. Other notable disadvantages include: Point 1. Operational challenges. The development and maintenance of secure and resilient CBDC infrastructure would be a massive and costly undertaking, requiring significant technological expertise and resources. Point 2. Financial exclusion. While often touted as a tool for financial inclusion, a CBDC could inadvertently exclude those who are not digitally literate or lack access to the necessary technology, such as smartphones and reliable internet connections. Point 3. Impact on monetary policy. The introduction of a CBDC could complicate the implementation of monetary policy, as the central bank would need to manage the interplay between the digital currency, physical cash, and commercial bank deposits. In conclusion, while the concept of central bank digital currency may offer certain benefits, the potential downsides are substantial and warrant careful consideration. The risks to privacy, financial stability, and individual liberty are significant and raise fundamental questions about the future of money and the role of the state in the financial lives of its citizens. As countries continue to explore the path toward digital currencies, a thorough and transparent public debate on these critical issues is essential to ensure that any potential implementation does not come at an unacceptable cost. Is it time to pay close attention to the activities of your financial institutions and government? Let's have a debate.